Hey, this is Jussi. I run a small investment firm that specializes in REIT investing, and overall I've done quite well over time. I've had many more wins than losses, and I've managed to significantly outperform my sector benchmarks like the Vanguard Real Estate ETF, so I'm done quite well. I'm pleased with the results. However, I've still had my fair share of setbacks along the way, some investments that didn't play out as planned and end up losing me significant money, and that's going to be the topic of this video. I'm gonna discuss my 3 worst REIT investments ever. They led to significant losses, and hopefully you can learn from my mistakes so that you don't have to suffer the same losses as well. But before I get into it, let me know in the comment section below what have been your worst investments ever, and also please click the like button if you appreciate this type of videos. Thank you so much in advance. So the first REIT I'm going to discuss here is called CBL Associates Properties. Its ticker symbol is CBL. This is a mall REIT in which I invested prior to the pandemic. Back then it was often pitched by value investors as a great investment opportunity because of its exceptionally low valuation. It was commonly trading at just 4 to 5 times its cash flow. It was priced at about half of its net asset value, so essentially you're getting the properties at a 50% discount. And its dividend yield was commonly over 10% despite retaining about half of its cash flow. Everyone knew that malls were suffering as a result of the growth of Amazon, but the valuation was so low that we thought that it was still an attractive investment opportunity. Even if you assume that the cash flow would be declining by 5% annually going forward, you would rapidly recoup your investment since you were just paying 4 times its cash flow, which equates to a 25% annual return. Moreover, up until then, the sales per square foot of its malls were actually stable or even slightly rising, and the same also for the rent per square foot, which indicates that the malls were not facing any severe crisis. It should be noted here that CBL owned lower quality malls than those of Simon Property Group or NAREIT as an example, so they were riskier. However, these were still typically the dominant malls in its secondary market, and as a result they were doing still fairly well to that point. Moreover, CBL was in the process of heavily reinvesting in its malls to make them e-commerce proof by including more services, entertainment and other non-retail uses such as dental clinics and libraries and other things. So in short, the valuation was very low. There was no growth, but that wasn't really needed because the valuation was so low. You're getting a high dividend yield. We thought that the cash flow was unlikely to collapse anytime soon. Perhaps it would start declining in the future 10 years from now, but we wouldn't see a sudden collapse in it. And finally, we thought that there was quite significant upside potential because, as I mentioned earlier, CBL was heavily reinvesting its properties to make them mixed-use destinations, and we thought that this would eventually make the company more resilient, justifying a higher valuation multiple. But I made one major mistake in my analysis, and that's ultimately the reason why this investment went wrong, and it is that I underappreciated the need for capex here. I thought that as the company was reinvesting its properties, that this was mostly growth capex, that it was discretionary capex, and that the company could stop it and do just fine, but this wasn't the case. And in reality, if the company had stopped reinvesting its properties, then the dominoes would start to fall pretty quickly. Yeah, the sales per square foot would start to decline, vacancy would start to rise. It was very much mandatory capex, and if you had adjusted its cash flow for this capex, which wasn't really increasing the cash flow, just keeping them stable. So if you reduced the cash flow by the capex amount, you also adjusted the leverage metrics for the capex and also adjusted the payout ratio for the capex, you would have concluded that the company wasn't quite as cheap and it was far riskier than it seemed to me when I invested in the company. Unfortunately, before I realized this, the company's share price had already dropped significantly. It eventually cut its dividend, and then even worse, in 2020 started the pandemic, and this was ultimately way too much for the company and it forced it into bankruptcy. I ended up suffering a very big loss, but fortunately I didn't lose quite all of it like most common shareholders, because I had switched from the common to the preferred equity in 2019, and then during the bankruptcy the preferred was converted into common in the new company. I still suffered a very significant loss, and this was a very poor investment, but there was a valuable lesson in this, and it is that you shouldn't, in your capex, you should make sure to understand what's the nature of the capex. Is it discretionary or is it growth capex, and what's really the importance of it? And then you need to make sure to adjust the different metrics like the FFO multiple, because FFO doesn't account for capex. You need to adjust for that. Then you also need to adjust for it when looking at the leverage based metrics like the debt to EBITDA, because your debt to EBITDA may seem low, but then once you account for the capex, it might be way higher. Same for the payout ratio. Quite often REIT investors will think that the dividend is safe because you have a, let's say, a 70% FFO payout ratio, but if the REIT need to invest very heavily in capex, perhaps the dividend isn't quite safe. And that was the case here. It taught me a very valuable lesson, and I'm glad I got to learn it back then when I was managing smaller amounts of money. Before going to the next company, I also still wanted to point out that I think that what happened to CBL is quite interesting today for the office REIT sector, which is often pitched by value investors as being heavily undervalued. But once again here, if you adjust for the capex, I think that the valuations of many of these REITs like Boston Properties, SL Green, isn't quite as low as it may seem, and this is why we are not investing in its property type at High Yield Landlord, which is my REIT newsletter. And by the way, if you want to access our full portfolio, you can do so by joining us for a 2-week free trial. It will be the first link in the description of this video. Okay, second company I'm going to discuss here is called Branix. This was also one of my worst investments so far. Well, I think that CBL was my fault. I think that Branix was more the series of bad luck. For a long time, this was actually one of my best performing investments. I had bought my shares at a very reasonable valuation, actually a pretty steep discount to its net asset value, even as the company was growing its cash flow and its dividend at a rapid pace. And so it was a very good investment for a while. But what went wrong with the company is that then came the pandemic. So this was the first black swan. And this was a big issue for it because it invested mostly in office buildings. This is an asset manager that was always raising more capital to reinvest in growth, to grow its fee income. But post-pandemic period, nobody wanted to invest in office buildings anymore. So this derailed their growth prospects. That was the main issue that they had back then. How they tried to resolve this issue is by acquiring another REIT-like entity called VIB. This was an industrial real estate investment firm. So the idea was to acquire this company and then be able to reinvent itself as an industrial-focused real estate investment firm, to start raising capital again, grow the fee income. I think it was a very good gamble for them, but the problem was that they took on a lot of leverage to close this acquisition. A lot of this leverage had pretty short maturities, and so the idea was to then sell some of the assets to pay off the short-term debt. But then things got even worse. Interest rates started surging shortly after. It became more difficult to sell assets, and what was really the last nail on the coffin is when Russia invaded Ukraine. And so suddenly there was no transaction activity at all in Germany and elsewhere in Europe. Inflation surged, interest rates surged even higher. It became near impossible to sell assets, and so here we are today. The company is way over leveraged. It's just shy of breaching its debt covenants, and so the market fears that the company may go into bankruptcy if it goes into technical default. And so that caused its share price to drop very significantly. Its NAV today is still at 17 euros per share. Its share price just 2 euros. It's showing you that the market thinks this company may go bankrupt, but I haven't lost hope here. I just recently highlighted in a different video that's entitled 2 REITs that could triple in 2025, and I think that the company is now in a good position to start selling assets more aggressively as interest rates return to lower levels. I also think that the NAV of the company may increase a little bit in the near future as cap rates compress a bit and rents keep on growing in Germany. So I still have hope, and I think that this could turn out to be once again one of my best investments in the coming years. But this goes to show that it's not always the analyst's fault actually that you suffer losses. You're taking risks and to returns, and sometimes the risk factors will play out. And I think that while CBL was my fault, I think that Branix was more the result of bad luck. There were 3, not just 1, not 2, but 3 black swans here: the pandemic, the surge in rates, and then Russia's invasion of Ukraine. Yeah, sometimes you suffer losses, and this is why it's so important to diversify your portfolio. Today in our core portfolio at High Yield Landlord, we have 24 REITs, and so we will occasionally face some setbacks, suffer some losses, but hopefully some other investments will perform even better than expected, and they will compensate for those occasional losses. Again, I haven't lost hope in Branix. I still hold a position. I bought more shares as low as 1 euro per share, and today we are double of that, but it is a speculative bet, and I wouldn't bet the farm on this one. And then the third company is Medical Properties Trust, ticker symbol MPW, and this one is once again my fault. This is not just a question of bad luck. I did mistakes in my analysis, unfortunately, and I'm paying the price today. I should have listened to the warnings of the short sellers when they came out, because back then the share price was still a lot higher, but just like many other bullish investors, I made the mistake of too quickly dismissing them as being self-interested short sellers that were trying to spread fear. when in reality this wasn't the case at all. But I think that one reason why I made this mistake is because up until then, Medical Properties Trust had been a great REIT for me, had performed really well. The management had a very good track record, having massively outperformed the averages of the REIT sector, which to me indicated that they were well aligned with shareholders. And quite recently also we had a few interesting cases with short sellers attacking REITs for the wrong reasons. As an example, I still remember when Farmland Partners was the victim of a scam, essentially, as short sellers fabricated a story, spread it out. It caused its share price initially to decline by 40%, I think, in a single day. And so I had those situations fresh in my memory, and that perhaps caused me to dismiss the ideas of the short sellers, when in reality I shouldn't have. Eventually the short thesis played out. The REIT's biggest tenant stopped paying its rent. It eventually filed for bankruptcy, and this has put Medical Properties Trust in a very tough position because it's quite heavily leveraged and it has a big tenant not paying its rent. And so yeah, I mean, the big lesson in this case, I think, is that you should make sure to listen to short sellers. You should take them very seriously. Quite often, as it was in this case, they are actually the investors who've done the most research on the company. Yeah, I mean, to recap this entire video, we discussed 3 companies. CBL, the big mistake was to underestimate the impact of capex. In the case of Branix, I think that it wasn't necessarily as much my fault, but it was more, you know, the result of bad circumstances. Black swans do play out and you'll suffer losses. So the lesson there is to make sure to properly diversify your portfolio. And then thirdly, in the case of Medical Properties Trust, make sure to listen to short sellers. They are often smarter and better researched than we are. So don't dismiss them just because they disagree with you. Finally, once more, if you could please click the like button, that will help me a lot to keep on growing. Let me know in the comment section below what REIT investments have led to big losses for you. And finally, if you want to access my full portfolio, be the first link in the description of this video. Thanks so much, and see you at my next one. Bye bye.